So let's do a question on professional firms. And open with me from your handout. Yeah, handout page 43, question 3. Handout page 43, question 3. There is a question there on professional firms. So in our classwork, we did question 1, question 2, we did it. Then now let's do question 3. So just a quick recap on how to account for professional firms. Those are the advocates. And we say that they are professional firms which offers legal advices for their client at a considerations known as the fees income. Then we say that there are 3 major accounts prepared. One was the cash book and cash at bank, which should be a 2-column. That is for the office and for the client. Then debtors and disbursement account. And then also we said we open the client account. So let me open cash at bank account. For the office and for the client, office, client. So let's go through that question. And you're told that Juma and Company Advocate is a law firm operating up country. Provided below is the balance sheet of the firm as at 30th June 2018. So we're given the statement of financial position. Let's go to the required. Income statement for the year ended 30th June 2018. And then number B is a statement of financial position as at 30th June 2018. So that means for the accounts will be working here, carries no marks, because in this case directly they want the income statement and the balance sheet. So for the cash at bank, let's start with the balance brought down from the balance sheet. Balances brought down. And for the office, we had 300. And for the client, we had 250. I don't have to open for the client account because the balance carried down the client account should be the same with the one for the client account. Or let me just show you. Just do it. So debtors and disbursement account. And also the client account. For the debtors and disbursement, it's an asset. So let's get the balance brought down. And we had a balance brought down of 330. Client account, we said it's a liability. It's money held on behalf of the client. So balance brought down will be on the credit side. Let's go to the current liability. We have the client account, an amount of 250. Yeah, and the amount in the cash at bank on the client column should be the same with the cash in the client account as a liability. So now let's go to the rational information. And we are told that the following transactions were carried out by the firm during the year. Number 1, received 850 on behalf of the client. So that's an actual cash inflow. And that one we received on behalf of the client. So on the client column, cash book on the debit side, we received 850. So that's for the client. And we say that anything affecting the client column on the cash book will have to affect also the client account. So you debit the cash, you credit. So they received cash on behalf of client, an amount of 850. Number 2, spend the following amount on behalf of the client, which were all paid in cash. So that's an actual cash outflow. And we had payment, that one reduces our cash. So they purchased equipment, and that was on behalf of the client. So equipment from the current column, an amount of 260. Then payment of rent, an amount of 130. Also repair cost. And repair cost was an amount of 80. And then anything affecting the current column will have also to affect the current account. You credit, you debit. So from the cash account, they purchased equipment worth 260. Also, they paid rent, an amount of 130, and also repair cost, an amount of 80. Number 3, purchased new equipment for the office use for 400,000 and paid 100,000, and the balance remaining is a loan. So we purchased equipment for the office, therefore it's a cash outflow. So we purchased equipment, but you only paid 100,000. Now the balance of 300 will take it to the part of the current liability, and that one becomes a loan. Number 4, spent 350 on the purchase of land on behalf of the client who had a credit balance with the firm of 120. They purchased land, so that's a cash outflow. They purchased land worth 350 on behalf of the client, and this client had only 120 in his account, 120, but we spent 350. So that means there was a disbursement, the amount paid on behalf of the client with insufficient balance, which is an amount of 230. So how did you treat this 230? This 230 is what we call the disbursement. You credit the cash account, you debit the debtors account. So you show that from the client, there was a disbursement, an amount of 230. And then from the client, we spent 120. And this 120, you credit, you debit here. So you purchased land from his account, you withdrew 120. Number 5, charge client 1050 for the services rendered during the year. So that's what we call the fees income, and that's what we charge the client. So we charge them, but we never receive. So that one will not affect our cash at the bank. Okay? So it will increase your debtors. So we had fees income, and we charge 1050,000. So you debit the debtors account, you credit the income statement. Of this amount we charged, we received an amount of 680. So that's a cash inflow. So the debtors, they paid, those are our clients who paid, and they paid in our account an amount of 680. So you debit the cash account, you credit the debtors account. Of this 1050, we received cash, an amount was 680. Then the firm further received authority from client to transfer 240 from client account in settlement of the amount due from the firm. We see that whenever there is a transfer, that one will have 4 entries. One is transfer, and we are transferring that amount from the client, and we transferred an amount of 240 from the client. That means it's an outflow from the client account, but it will be an inflow in our office account. So we had a transfer from the client. That one is to pay off, to reduce the amount of debtors, an amount of 240. If we receive 240 for the services rendered, that means our debtor also will have to reduce because they have paid us 240. So client, they have paid us 240. And then what we transferred from the client account, you credit the client account, you debit the client account. So from the cash account, on the client column, you credit, so you debit here. And that amount was to pay the debtors. And we paid debtors an amount of 240. That means you credit, you debit, and then for the debtors, you credit, but you debit the client account. Number 7, the following expenses were incurred and all were paid in, all were settled in cash. So that's a cash outflow. So they paid rent, an amount of 120, also salaries, an amount of 360. Then we have office expenses, an amount of 90. Then we have interest on loan, an amount of 30. And then we have loan repayment. an amount of 300. Number 8, during the year, the firm received 480 from client in settlement of disbursement made during the year on behalf of the firm. So we received 480 from client to pay off for disbursement. So that means it's a cash inflow. So from the disbursement, the office received from client an amount of 480. Therefore, you reduce the disbursement account that we received an amount of 480. Number 9, purchase library books worth 160 and paid them in cash. So library books, those are cash outflow. Library books, an amount of 160. Then number 10, sorry. Purchased, it's not purchases, purchase stationery on credit for 210. Now the one we purchased on credit will not affect our cash at bank, and paid creditors a total of 240 during the year. So we paid creditors. So we paid creditors an amount of 240 during the year. Then number 11, drawing for personal use during the year amounted to 180. So those are the drawings. So drawings is an actual cash outflow, an amount of 180. Number 12, on 30th June 2018, stationery in store was valued at 160. On the same date, the work in progress was valued at 350. So that one does not affect that. The firm provides depreciation on book value. So depreciation does not affect our cash account. So now let's get the balance and then let's close the accounts. So we get our balance carried down. Also here we get the balance carried down and the balance carried down. So here we have 210. That's the balance carried down. We go to the balance sheet. Here we have 270. So you have a balance carried down of 270. This side looks to be more, so that's 330, 120, 360. Yeah. So in this case, we have a bank overdraft. So the balance carried down from the office is an amount of 110. So that means you have the balance on the debit side. So in the trial balance will be on the credit side. So that's a bank overdraft. We spent more than what we had. Good. So now with that, let's answer the question. What was the requirement? Required, number A, is the income statement. So let's present the income statement. That was SH, Juma and Company Advocate. Presenting the income statement. For the year ended 30th of June 2018. So we start with the incomes. For the incomes, we had the fees income. How much was the fees income? That was courtesy of note number Number 5, charge current 1050 for the services rendered during the year. So you take 1050, then we said you add work in progress balance at the end, then you raise work in progress balance brought down. So let's go to note number 12. On 30th June 2018, stationery in store was valued at 116. On the same date, work in progress was valued at 350. So you add 350, then you deduct work in progress at the beginning. So that's from the trial balance. Let's go to the balance sheet. The balance sheet under current assets, we have work in progress, an amount of 210. So that one will get 1400. 1400 minus 210. Is it 1190? To be 1190. So then we deduct the expenses. And in this case, you only factor the expenses that belongs to the company, not for the client. So let's go to note number 7. The following expenses were incurred and were all settled in cash. So we paid rent. Our rent was an amount of 120. Then salaries, amount of 360. Then we had office expenses. For the office expenses was 90. Interest on loan. For the interest on loan was 30. Then this is a question I had given out in your card. Loan repayment is not an expense. That one reduces the liability. What's an expense is only the interest on loan. So loan repayment is not an expense. Then we have stationery. Stationery, it's an asset. Let's go to the balance sheet at the current assets. How much is the stationery? From the balance sheet, the opening stock for stationery was 140 plus, let's go to note number 10. Purchases stationery on credit for 210. So during the year, we purchased an additional stationery worth 210. So that means in the stock, we are supposed to be having how much? 350. But you are told that you want to determine the stationery used during the year. Let's go to note number 12. On 30th June 2018, stationery in the store was valued at 160. So you can call it either depreciation or you can call it stationery used. So you take, so that means we used stationery during the year worth 190. Then let's go to number 13. Number 13. The firm provides for depreciation on book value using the following dates. So we provide for depreciation. One is for the equipment, also for the furnitures, also for the library books. Equipment is at the rate of 5%, 10%, 12.5%. How much was the equipment? Let's go to the balance sheet. And the equipment was 800. Then you add. Note number 3. Purchase new equipment for the office use for 400,000. Then we purchased an additional 400. So that's 1,200, 5%, 120, that you get 60. And then we have furnitures. How much was the value of the furnitures? Furnitures is 350 and you get 35. Then library books. How much was the library books? We had 280 plus, let's go to note number 9. Number 9. Purchased library books worth 160 and paid them in cash. So during the year, we purchased library books of 160 and that you get 440. 440 times 12.5, that's 35. Yeah, 55. So, and I think those are the expenses that affected our income statement. Didn't have anything else. Actually, you can present the income statement without presenting this because income statement has not been affected by this. So it's 1190. To get a profit of 250. 250. So you can take a screenshot of that. So let's present the balance sheet. So for the balance sheet, I just want to grab this. So let's start with the assets, non-current assets. For the non-current assets, just go to the balance sheet you are given, just copy what you have. So they had equipment. Also, they had furniture. And also they had library books. Equipment was 800. Then we purchased 400. And then there was a depreciation. Was it 60? Yeah, that depreciation was 60. Then for furniture, we had 350. We minus depreciation of that 5. Library books, we had 280. Then during the year, we purchased library books worth 160. And then you raise depreciation of 55. So what do you get as the net book value? So this is 1140. So this is 315. So that is 440 minus 55. That is 385. So we go to the current assets. So on the current assets, we had work in progress. Then we had stationery. Then we have debtors and disbursement. And then we have cash at bank. For the work in progress, you take the balance at the end. That's courtesy of note number 12, which was 350. Stationery, still at note number 12. You take the balance at the end, and at the end it was valued at 160. Debtors and disbursement, you have that account here. And the debtors and disbursement, our balance carried down is 210. Then we have cash at bank. So for the cash at bank, for the client, there is 270. But for the office, the balance is on the debit side. So that means it's a bank overdraft. So for the cash at bank, we only have for the client an amount of 270. The other 110, you take it as part of current liability. Then we go to capital and liabilities. To the capital and liabilities, you take capital balance brought down. Then you add the profit and you deduct drawings. So they had a capital of how much? So the capital was 1,800. Then you add the profit for the year. During the year, they made a profit of 250. And then you deduct the drawings. Note number 11. Drawing for personal use during the year amounted to 180. So they had a drawing of 180. So how much will be the net capital? So that is 2050. Deduct 180. You have 1870. Then non-current liabilities. For the non-current liabilities, we have a loan. And loan is an amount of 800. Then we have the current liabilities. For the current liabilities, we had creditors. So now for the loan was an amount of 500. Remember, I purchased an equipment worth 400, but you only paid 100. That is courtesy of note number 3. Purchase new equipment for the office use at 400, and paid 100. And the balance remaining is a what? Is a loan. So there is a loan of 300. So that means that we are getting 800. Creditors, how much is the creditors? From the trial balance, we have a creditors of 110. Then you add, we go to note number 10. Number 10. Purchase of stationery on credit. We purchase stationery on credit worth 210. So that means we are supposed to be having a creditors of 320. But still at note number 11, purchase stationery on credit for 210 and paid creditors a total of 240 during the year. Then we paid them a total of 240. So how much will be the outstanding balance? So that's an amount of 320 minus 240 you get. Is it 100? Sorry, it can't be 100. It's 110. Yeah, it should be 80. That's 80. And then lastly, we had client account. Now for the client account, we have money held on behalf of the client. So from the client account, we had a balance carried down of 270, as well as we had a bank overdraft for the office. Bank overdraft, an amount of 110. Yeah, actually for the loan, there was a repayment. Yeah, can we go back to note number 7? Number 7, we had a loan repayment of 300. So we had 500, then we purchased equipment, we had a loan of 300, and then we also paid 300. So you get 500. Good. So let's balance that. Get 28, 30. So can take a screenshot of that. So I want us to do now another topic. So that's all about the professional firms. I want us to do a question on banks. How to account for banks. Banks, they are financial institutions. And we say that when accounting for banks, their major source of income are the interest on loans, and also their major expense are the interest on customer deposits. Then the special treatment of accounting for bank was that to the balance sheet, you don't separate the assets into non-current and current assets. Rather, you arrange the assets in the order of liquidity, starting with the most liquid assets. And then you see that the income statement, for the income parts, you take the interest income, you less interest expenses before you add any income or any expense. So accounting for banks. So open this question. May 2016, question 5B. May 2016, question 5B. So let's do that. So the following 12 balances was extracted from the book of Maendeleo Bank Limited as at that 1st March 2016. So we have that. So we have PPE, interest on loans and advances, interest on customer deposits. We have share capital, revaluation reserve, salaries and wages, borrowed funds, directors' emolument, depreciation on plant and equipment. We have other interest income, specific provision for doubtful debts, interest on government securities, other operating expenses, repaired maintenance, printing and stationery, deposit and placement due from other banks, loan and advances to customers. We have deposit and placement due to other banks, interest received on deposits and placement with other banks, other interest expense, interest paid on deposit and placement from other banks, cash and balances with central bank, interim dividend paid, bad debt written off, share premium, fees and commission income, dividend income, investment in securities, miscellaneous accruals, government securities, retained earnings. Then we have other assets. Additional information. Analysis of the debtor's balance at the end of the year revealed that an additional provision of 3.7 for non-performing loans should be made. Number 2, a provision of 2.1 should be made for tax on the profit for the year ended that 1st March 2016. Interest accrued and not accounted for in the books as at that 1st March 2016 was as follows. So we have that interest on loan advances, interest on customer deposits. Then number 4, directors on the bank have proposed a final dividend at the rate of 5%. Required, prepare for Maendeleo Bank Limited. So we have that. So, and then let me address some queries students are asking that I'm ignoring them. I'm not ignoring them. Eh? So what happens, I'm doing blocks. And when I'm doing blocks, I cannot be teaching here and the one controlling the laptop. So kindly, this being the blocks, ask the question after the class, because some queries I can see, others don't have the handout. If you don't have handout, that's not my responsibility now to say now. Eh? You must be having that handout. So kindly let make it clear. So we are doing the computation. So let me focus on this one. So I'm doing computation. So in case you have a question, ask after the class. Good. So income statement. Maendeleo Commercial Bank Limited. So then we present income statement for the year ended 31st March 2016. So let's start with the interest income. Remember, we said that for the bank, we always start with the interest income. Then we less interest expenses for us to get the net interest. So let's combine all the interest incomes. And we have interest on loan and advances. Interest on loans and advances was an amount of 16,790. Then let's go to note number 3. Note number 3. Interest accrued and not accounted for in the books as of that 1st March 2016 was as follows. So you have interest on loan and advances, an amount of 1284, which was not accounted for. That's an income. So therefore you add, we have 1284. So how much is the interest? You have an amount of 18,074. Then any other income? So also you'll be deducting the interest expense. Then we have interest on customer deposits. That's an expense. So interest on customers' deposits. It's an amount of, how much is that? An amount of 10,616. That's an expense. Then you add note number 3. We have interest on customer deposit, which was not accounted for. So an amount of 896. So we have 10,616 plus 896, 11,512. Then any other interest income? We have other interest income. That's part of incomes. Other interest income, amount of 860. Then we have interest on government securities. That's an income. Interest on government securities, an amount of 9536. Then we have interest received on deposit and placement with other banks. So we have interest received on placement with other banks, an amount of 76. Then we have other interest expense, other interest expenses, an amount of 628. Interest paid on deposit and placement with other banks. So interest paid on placement from other banks. We have 2560. Then we have, do you have any other interest income? No, we don't have. So Now let's get our net interest income. Net interest income. So once we get the net interest income, now we can add other incomes, and then we deduct other expenses. So what do we have? So we had we have salaries and wages. That's other expenses, salaries and wages. That one will deduct 4368. 4368. Directors' emolument, it's an expense, an amount of 1290. Depreciation of plant, a depreciation is an amount of 1630. Then we have specific provision for doubtful debts. Is it an income or an expense? That's an income. Specific provision for bad debt. How do you know it's an income? Now, can you pick any expense? For example, can you take depreciation? Depreciation is on the debit side. So all expenses are debited, all incomes are credited. Now let's go to the specific provision for doubtful debts. It's on the credit side. Now that's what we call reduction in provision for doubtful debts. An increase in a provision is an expense, a decrease in a provision is an income. And in this case, for specific provision for doubtful debts, it was a reduction. That's why it's put on the credit side. So therefore, it's an income. 55. Then we have other operating expenses. So other operating expenses, amount of that 260. Repair and maintenance. Repair and maintenance, amount of 420. Printing and stationery. Printing and stationery, an amount of 556. Then we have bad debt written off. Bad debt written off, that's an expense, an amount of 558. Then we have fees and commission income, that's part of other incomes. Fees and commission incomes, an amount of 6,000, no, 1528. Then we have dividend income, so it's part of other income. The dividend incomes, an amount of 816. Investment in security is an asset. Miscellaneous accrual is a liability. Government security is an asset. Retained earnings. Then we have other assets. Let's go to additional information number 1. An analysis of debtors' balance at the end of the year revealed that an additional provision of 3.7 for non-performing loans should be made. That's provision for doubtful debts. And they made an additional provision for non-performing loans, an amount of 3.7. Good. Then I think that's all what we have. So with that, now let's get the profit before tax. Once you get the profit before tax, you raise the tax expense. And how much was the tax expense? Note number 2. A provision of 2.1 should be made for tax on the profit for the year ended that 1st March 2016. 21. And that's how you get the profit after tax. Then from there, directors have proposed a final dividend at the rate of 5%. So dividend proposed. So in most of the cases, they usually take either 5% of the profit or 5% of the share capital. So in this case, they never specified. So let's take 5% of the ordinary share capital. So you assume it was per share. And how much was the ordinary share capital? Yeah, share capital was 20,000. And 5% of 20,000, it's 1,000. So that we get the retained earnings for the year. So now let's compute the profit before tax. So that's okay. So you can take a screenshot of that. Let's take a screenshot. So let's present the balance sheet. So we start with the assets, and we see that to the balance sheet, you don't separate them into non-current and the current. You only arrange the assets in the order of their liquidity, starting with the most liquid assets. And in our case, Do you have any cash? Yes, we have cash and balances with the central bank. Amount of 7260. Any other asset we have? We have, so we have investment in securities. An amount of 10,920. Then we have government securities. The government security have 26,400. Then we have deposit and placement due from other banks. Deposits due from other banks. Now, due from, it's a part of current assets, but deposit due to other banks is a liability. Amount of 17,120. Then we have loan and advances to customer. Loan and advances to customer, an amount of 135,310. But of this amount, there is a provision of non-performing loan. Let's go to note number 2. A provision of 2.1 should be made, sorry, not number 1, not number 1. An analysis of the data balance at the end of the year. Do you have any account receivables? In case we don't have any account receivable, that means it will affect our own advances. Actually, that's the data for the bank. The data for the bank are the loans and advances. Analysis of the data balance at the end of the year revealed an additional provision of 3.7 for non-performing loans should be made. So you raise 3.7. What do you get? And that 5,310 is that 700. 1.1600. On that 1,610. Then let's go to note number 3. Number 3, we are told that accrued interest accrued and not accounted for in the books as of that 1st March 2016 was as follows. We have interest on loan and advances. That's an income which is not yet received, so it's part of receivables. So we have interest receivables on loans. And we never accounted for 1284. So do we have any other assets before we include our PPE? PPE should be the last item of the intangible assets. I don't think we have any other assets. So now we can include our PPE. So how much was the plant, property, and equipment? We have an amount of 28,854. Being that's all what we have. Present the balance sheet. So to the balance, to the statement of changes in equity. So you take capital and liabilities. And at the capital and liability, we had the share capital. And the share capital, we had an amount of 20,000. Then we also had share premium. Share premium, an amount of 6,000. Then we have retained earnings. For the retained earnings, we have 4960. You add retained earnings for the year. 10,332. 10,332. Also, before that retained earning, there was another interim dividend paid. They are paid an interim dividend of 8. So it's okay. So that means you can also adjust here. So this was a proposed dividend. the proposed dividend was 5%, and also they had already paid an interim, an amount of 800. So that means the total dividend paid during the year was 1,800. Yeah, so this is 1,000, so it's 1,800. So that means the retained earnings for the year, so it's 11,332 minus 1,800, it's 95,32. 95,32. So here we can just add directly 95,32. Amount of 14,492. So let's go now to the non-current liabilities. Do you have any long-term borrowings? Number one, we have customer deposits. Customer deposit. That's not a current, it's an non-current. Amount 164,460. Also here we had revaluation reserve. Revaluation reserve is part of capital, an amount of 49,60. Then we had borrowed fund. That's an non-current liability, an amount of 70,40. Then we have deposits due to other banks. How much is the deposit due to other banks? An amount of 12,820. Then we go to the current liabilities. To the current liabilities, number one, also here we never included other assets. I can see we have an amount of assets we never included as a part of current assets. So before PPE, we had other assets before we bring our PPE. So 28,854. And for other assets, was an amount of 10,600. So on the current liabilities, we have miscellaneous accruals. Amount 280. Then number three, interest accrued and not accounted for. We have this interest on customer deposit. That's an expense. So that means an expense we have not yet paid. So we have interest accrued, an amount of 896. Then we have proposed dividend. We have not yet paid. So therefore becomes a liability, was an amount of 1,000. Also, number two, a provision of 2.1 should be made for tax. So that's what we call the current tax, an amount of 2.1. So I don't think we have anything else. I think we have exhausted everything. Good. So that's how you present the statement of financial position. It's all about doing that. For the assets, we arrange them in the order of liquidity, starting with the most liquid asset. But for the equity and liability, nothing changes. So we can take a screenshot of that. So now let's look at accounting for public sector. Public sector accounting. Public sector accounting. So open June 2013, June 2013, question 5C. June 2013, question 5C. So number C, you're told that the following information was extracted from the book of Ministry of Finance for the fiscal year ended 30th June 2012. Let's go to the required statement of financial performance for the year ended 30th June 2012, and then the statement of financial position. So let's start with the statement of financial position. That's Ministry of Finance. And then we prepare statement of financial performance for the year ended 30th of June 2012. So our shillings are in thousands. So you say that when accounting for public sector, remember public sector, they are there to offer services to the member of the public. Therefore, they are not profit oriented. So start with the receipts. We deduct any expenditure. And we say that they use what we call the cash basis of accounting. So the first item we have is reserves, accumulated fund. And we said accumulated fund is equivalent to the capital. Then cash and cash equivalent, receivable, inventory, transfer from exchequer. So that's a receipt. Transfer from exchequer, an amount of 1250. Fees, fines, and licenses to the government, we say that's an income. Fees, fines, and licenses, amount of 250. Revenue from exchange transaction. Revenue from exchange transaction, amount of 50,000. Transfer from other ministries. $25,000. Then we have other revenue. For other revenue, it's an amount of 300,000. Payable is liability, land and building, computer equipment, wages and salaries. Those are the expenses. Wages and salaries, an amount of 500,000. transfer to other ministries, transfer to other ministries, an amount of 250. Supplies and consumables used, amount of 200,000. Other expenses, 600. Finance cost, an amount of 50,000. Long-term borrowing liability for long-term employee benefits. So now let's determine the surplus or deficit. We see that they don't record a profit. In case the inflow are more than the outflow, they'll call it a surplus. If it's the vice versa, it's a deficit. So 1,500 plus 375 minus 750 minus 850, you get 275. Now let's present the statement of financial position. Ministry of Finance, statement of financial position as at 30th of June 2012. So we have the assets. So what do we have to the non-current assets? To the non-current assets, I can see we have land, building, and furnitures. Land, buildings, and furnitures, an amount of 1,750. Computer equipment and motor vehicles, amount of 250. Then we go to the current assets. So under the current assets, we have cash and cash equivalents. Amount of 250. We have receivables. An amount of 100,000. Then we also have inventory, an amount of 50,000. Then we go to, we see that for their capital and liabilities, they call their capital accumulated fund and liabilities. So we start with the accumulated funds. And they had an accumulated fund as at 1st July 2011 of 375. Then you add the surplus for the year. And from the income statement, they had a surplus of 275. Then the first item, they had a reserve. Reserves an amount of 900,000. Then we go to the non-current liabilities. For the non-current liabilities, we have long-term borrowings. Amount of 500,000. Liability for long-term employee benefits. Then we go to the current liabilities. The current liabilities, we have payables, an amount of 250. So 375 plus 275 plus 900, 5, 6, 7, 8, 850. So you can take a screenshot of that. Good. Then still on the same page, the same page, but now for December 2012, there's that question number 2, part C. It's still on public sector. Let's do that. December 2012, question 2C. It's on the same page. It's on preparation of the comparison between the budget and the actuals. So that's December 2012. Question 2C. So part C, I told that the following information was compiled by the Ministry of Finance for the fiscal year ended 30th June 2012. So you are given the budgets, also you are given the actuals for both the receipts and the payments. So let's go to the required. Budget outturn for the Ministry of Finance in accordance with International Public Accounting Standard, that IPSAS 24. So we prepare the statement of budget outturn. Now for the outturn, you need to compare the budget against the actual. So we have the budget and the actuals, and the difference between the two will give rise to the variance. So let's start with the receipts. Just copying what we have. Then we get the total. Then we have the payments. So for the payments, we have education. So I've just copied what we have, and then we get the variance. So what's the difference? So 180 minus 165, we have a difference of 14,400, have a difference of 6,000, a difference of 1,200, have a difference of, that should be 40, so that's 36. Then we have a difference of 48. We have a difference of, that should be 20, so it will be 18. Then we have 180, so that is 19,200. Then we have a difference of, is it 12? Then we have a difference of also 12. Also, we have a difference of 12, a difference of 18, and a difference of how much? 72 minus 48, a difference of 24. Then we say that for the variance, it can either be adverse or favorable. So now let's start with the receipts to determine whether the variance are favorable or adverse. So in this case, receipt is what you expected to receive, and you had budgeted to receive 180. You ended up receiving 165.6. Is it a good idea or a bad idea or a bad outcome? You budgeted to get 180, we ended up getting less than what we expected. So that one is a bad. So therefore, it's an adverse. You budgeted to get 24, you ended up getting 18. Still, that's a bad idea. So it's adverse. You budgeted to get 18, you ended up getting 19. So you got more than what you expected. Therefore, that's a favorable. So it's a positive. 120, you ended up getting 84. That's adverse. 48, but you got 96. You got double. So that's a good idea. So it's favorable. 72, you ended up getting 90. So that's favorable. So now let's get the net. And I'm getting an amount of 10, which is favorable. Then on the other side, now let's argue for the payments. Payments are the outflow. How you argue for inflow is already different from how you argue for the outflows. So in this case, for the payment, you had budgeted to spend 180, you ended up spending 160. So is it a good or bad idea? So that means you had a saving. So that's a good idea. You spent less than what you expected. 84, you ended up spending 72. So that means you had a savings of 12. It's a good idea. It's favorable. You budgeted to spend 54 on housing, you ended up spending 66. So that means you had an overspend of 12. So that's a adverse. That 6, you ended up spending 24. That's a good. So it's favorable. You budget to spend 72, you end up spending 19. So you overspend. Therefore, it's an advance. 48, you ended up spending 72. That's an advance. So let's get that. And you have 10.8, but it's a negative. It's a negative. So now we can get our net cash flows. Our net cash flows, we had a favorable from the receipts of 10,800 minus here you had a total of 10,800, but it's a advance. So the net cash flow is 0. So you can take a screenshot of that. So and that marks the end of today's session. So kindly go and revise in advance. Published. God willing, that's what we'll do in our next session.